Hey guys, Max here, and this is of course your daily market update for yesterday, the 29th of July, and it is now the weekend. This week of trading has finished and it was a really strong week, and it was a strong day yesterday as well too. Some big tech companies performed really quite well. Amazon up by 10% for the day, Tesla up by almost 6%, and then some oil stocks performed quite well too. The S&P 500 then rose by 1.4%, with the Nasdaq outperforming and rising by 1.8%, and then the Dow Jones rising by just 1%. Across the rest of the world, it was similar but a little bit less bullish. The Americas were strong, Canada in particular, and Europe was okay. China was really quite poor, and we'll do a full video looking at just what happened in China over the last week because it really was quite volatile. And as you can see, they really had a bad day yesterday as the regulatory crackdown in China is continuing. As I told you it would day after day for over a year now, this crackdown will never end. On the whole then, the MSCI World Index rose by 1.2% for the day, and stocks rose by something like 8 to 9% on average over the last week with a really strong rally. Now, the dollar didn't really move too much yesterday, but it did weaken very slightly, as you would expect, as it's acting as a safe haven asset. The euro is still sitting at about $1.02. The pound is still sitting at about $1.22, and the yen actually rose by almost 1% against the dollar, up to 133 per dollar. For fixed income assets and the bond markets, we really didn't see much movement yesterday alone, but over the last week, we saw yields crash. The US 10-year Treasury yield only fell by about 1 basis point and now sits at 2.66%. The German 10-year yield fell by 1 basis point too, and the British 10-year didn't move at all. So really not much movement in the bond markets yesterday. And then finally, in the crypto markets, another relatively strong day. Bitcoin sitting close to $24,500, Ethereum sitting above $1,700, both moving up by a few percent, and the altcoin market is strongly correlated to those two bigger coins as well, as it always is. Assets have been up over the entirety of the last week. Really, pretty much every day over the last week was characterized by the same narrative of bullish stocks based on this idea that maybe we're through the worst of the Federal Reserve tightening cycle. And actually, most of the last month has been like that too, with a slight blip for a few days as we got that awful inflation data out about 3 weeks ago now, where we realized and we were told and shown once more that no, inflation isn't over. But about a week after that, and the markets and investors in general just stopped paying attention to that data and they pushed it to the back of their minds. It is now pretty clear that investors think that the end is near, that the Federal Reserve's tightening cycle is over, and that the markets should boom because of this. This graph behind me right now shows stocks over the last month as a whole, and as you can see, almost every single sector was up for the month. The only ones that weren't really strong was healthcare, and then a couple smaller niche industries fell too, like tobacco and things like that, but for the most part, really strong. Apple up by almost 17%, Amazon up by 24%, oil stocks up by about 10%, financials up by about 10% too, Tesla up by a monumental 30% for the month, so a massive rally for the entirety of the last month. It was actually the best one we've had in about 2 years now. Now, another big thing that's affecting the markets is the fact that quantitative tightening has never really started as the Fed told us it would. Now, they said that last month, basically, they were going to start reducing the size of their balance sheet by letting a bunch of their assets mature and by not replacing them with new assets, and they have been doing that, but they were also supposed to sell off loads of their assets to the open market at the rate of about $45 billion per month. And that they haven't done at all because, plain and simple, there are no buyers for mortgage-backed securities. So the Federal Reserve literally can't sell them and they can't start quantitative tightening, which is impacting bond yields as well. Investors are just hoping that it stays the same situation, that the Fed continues to not reduce the size of their balance sheet, because that would have a massive impact on asset prices if the Fed actually does their job and goes in that direction. Unfortunately, though, this is all basically based on hope and not much else. The economic situation is almost identical to how it was a month ago, except inflation's worse, the economy's worse, the job market is tighter, and other things are worse too. Nothing's really gotten better, but asset prices have boomed, basically on the hope that things are just going to end out of nowhere around this time. Now, the really massive problem that I think is really huge, but no one seems to be talking about, is the fact that actually this stock rally itself is bad for the markets. Now, that may sound a little bit weird, and it does come from a roundabout sort of logical idea, but it is a solid principle, and we do need to pay attention to it. Now, of course, Powell sent out the odd dovish comments and a few dovish actions. They basically ruled out the 100 basis point rate hike after markets panicked when we got that bad inflation data. And then the 75 basis point rate hike and his comments following the FOMC sort of sent markets up a little bit further too. This also, though, sent bond yields down dramatically because people were moving out of bonds and into risk on equities, as you would expect. And this also happened in the corporate bond market, not just with sovereign bonds and treasuries and things like that. Now, as a result of this, a specific Bloomberg index of US financial conditions actually improved massively over the last month because of this equity rally and the bond yield drop. The problem is that everything right now is about inflation, and that's the only real figure that actually matters to anyone who's invested in broad-based markets. To kill inflation, of course, you have to severely damage the economy, and that's really what we've been seeing the Fed doing for the first 6 months of this year. But last month's strong performance in asset prices is going to result in a stronger economy, and as a result of that, that's going to cause higher inflation in the future, meaning that the Fed will have to tighten more, not less, and so asset prices will then fall because asset prices rose. Now, this happens in a bunch of different ways. Lower yields means cheaper debt. It means it's easier to invest into a business. It's cheaper to invest into a business. It's cheaper and easier to grow a business and expand. And that is good for an economy, but it's bad for inflation. Stronger asset prices for businesses also means it's easier to raise money through IPOs or SPACs or taking a company public in general. It's also easier and cheaper to get money into the company via private funding rounds. And then it's also easier and cheaper to release new shares and get more funding to grow and expand a business that way. And again, that's good for the economy, but that's bad for inflation. Then finally, we have the fact that higher asset prices make people richer. The average person right now is richer than they were a month ago, at least according to their brokerage account, their investment account, their pension account, or even their crypto account. Now, when people feel richer, they act richer and they spend more money. They go out and they buy a luxury watch. They go out and they lease a brand new Mercedes, or they just spend money in restaurants and on, small consumer goods that don't really mean much, but do contribute massively to the economy. That is, again, good for the economy, but bad for inflation. The fact that asset prices are rising right now will actually cause them to rise in the future because the Fed has no choice whatsoever but to fight inflation, and this rally will cause more inflation itself. That's simply why this rally can't and won't last forever. Even if it does turn out to be a really sustained long bull run, in the end it will cause its own downfall, and there isn't really a way around it unless we get concrete data in the next couple of weeks that inflation is dropping and dropping incredibly quickly, which, let's all be honest, is incredibly unlikely. Now, there is, though, something counteracting this effect, and it's, of course, corrupt or just inept government institutions and the fact that the West is inundated with them. Now, it's no secret, but Democrats and Biden in general, that entire political wing, is suffering in the United States because of the bad economy, because of the recklessly high inflation rates we've got. Now, it also won't shock you to hear that midterm elections are coming up and the Democrats want to win. They're a political party. Of course they want to win, but their chances aren't looking too good. Now, the misery index is basically something that just looks at the average impact on the average person because of the state of the economy, and it is exactly what it sounds like. It rates people's misery based on what the economy is looking like, and right now it's at rock bottom levels. Now, when it is bad, we see incumbents lose their positions for the very simple reason that actually people want change when things are bad, and in a lot of places, things are bad. So we should really expect the Democrats to perform worse than they would if this economic turmoil had never happened in the first place. There is a possibility, and I stress possibility because I don't think it will actually go in any major direction and be successful, but there's a possibility that the Democrats push for a short-term respite in poor economic conditions to try and win this election cycle at the expense of everyday people. Now, in fact, this is already happening, at least to some extent. The biggest version of this, of course, being stimulus checks, which are back on the table in a bunch of different states. The biggest ones being probably California and Florida, but there are many others doing the exact same things too. Now, stimulus checks, plain and simple, cause inflation. We know this, you know this, everyone in the world knows this, including the people sending out these stimulus checks. But now these stimulus checks are being used to save people from this inflation because obviously some average people who don't really have a strong understanding of economics and how markets work, maybe they don't realize that stimulus checks are the reason prices are rising. Now, the sad thing about this is that this will hurt average and poorer people more than anyone else. The wealthy will not be impacted by this at all, despite the fact that they probably won't get any of these stimulus checks. The government, though, just doesn't care because it's hoping that it raises approval rates. Of course, this isn't a problem that is exclusive to the Democrats. Republican states are also going this stimulus route, but Democrats, by and large, hold more power in the United States at the moment. They are the incumbent, more or less, and so I do expect them to suffer more from this next election cycle than the Republicans. It is also possible that this goes even further. Now, Biden and the government, the White House, this administration, they obviously have a huge amount of influence over a number of different government institutions which are supposed to remain impartial, much like the Federal Reserve. Now, officially, they are impartial and they're a good, honest organization that never does anything wrong, but behind closed doors, we all know that the opposite is true. It is absolutely possible, and I dare say even likely, that some degree of pressure is applied to these officials like Jerome Powell to try and get them to boost markets and to boost the economy in the short term, to ignore inflation, and to try and just get past this next election cycle, and then to deal with the fallout afterwards. I do think ultimately it's unlikely that this happens to any serious degree, because at the end of the day, it would almost definitely be unsuccessful and would just create a bigger problem for the Democrats in the long term, but it is a possible thing that it is worthwhile we look out for over the next few months. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.